Will gold lose the $4,000 per ounce barrier next Wednesday evening? Or will it have a chance to move forward? Gold, which entered 2026 as the deal of the century after recording a historic peak of over $5,600 per ounce in January, has lost about 27% of its value so far and has fallen to levels below $4,100 per ounce since the beginning of this war. Everyone is asking how safe havens are declining at a time of heightened geopolitical tensions. The answer, of course, is the inflation trap. Markets no longer interpret the Strait of Hormuz crisis as a geopolitical threat driving them to gold, but rather as an inflationary threat. The surge in oil prices since the start of this conflict has brought inflation back into the spotlight, and consequently, expectations of an interest rate hike are increasing. Markets are now pricing in a 58% probability of the U.S. Federal Reserve raising interest rates at the end of the week, especially after the U.S. inflation figures released this week, which showed the fastest rate of inflation acceleration since 2023. Markets are also now looking ahead to the first meeting of the U.S. Federal Reserve under Kevin Warsh next Tuesday and Wednesday. Warsh will be forced to prove to the markets, the U.S. administration, Trump, and the global economic community that he will not succumb to Trump's pressure to lower interest rates, especially after the recent inflation figures and last week's strong labor market data, which warrant a hawkish monetary policy, meaning an interest rate hike, not a cut. This makes gold less attractive because it doesn't generate a return on investment compared to savings in banks or purchasing U.S. Treasury bonds, which pay higher interest rates and increase the real return. This hawkish tone and the anticipated interest rate hike also strengthen the dollar, putting significant pressure on gold demand in major markets like China, India, and Europe. So, what about central banks? Have they abandoned gold? The answer is no. Despite the declines, data reveals an accurate picture of central bank trends. January of this year saw a sharp drop in central bank purchases to just 5 tons, an 80% decrease from the 2025 average, according to data from the World Gold Council. However, central banks quickly regained their buying power, and the first quarter of this year ended with net purchases totaling 244 tons. The Polish Central Bank, for example, alone purchased 31 tons, while the People's Bank of China added 5 tons in March. This followed an exceptional decline in March due to gold sales by the Turkish Central Bank, as the Polyvolt report confirmed that what happened with Turkey was an exceptional case. Now, some might ask where the liquidity that usually supports gold has gone. In reality, there are 2 factors driving liquidity away from gold. First, the destruction of physical demand for gold, as the high prices it had reached led to the exclusion of buyers. The World Gold Council report confirmed that the first quarter of this year recorded the lowest level of demand for jewelry since the COVID-19 crisis, with sales volume declining by approximately 23%. Second, the massive SpaceX IPO, the largest in history, which aims to raise $75 billion, according to estimates by Goldman Sachs and other banks, is forcing investors to liquidate their defensive assets like gold. The World Gold Council has already confirmed that $2 billion flowed out of gold ETFs in May alone. So the question now is, will we see gold fall below $4,000? This scenario is strongly on the table. TD Securities explicitly warned that gold could test the $4,000 level and considered this the most likely scenario. JP Morgan Chase also issued a warning condition for a potential drop to test this barrier, meaning the $4,000 level. The common reason for both banks is the continued presence of oil prices above $100, which fuels inflation and forces the Federal Reserve to keep interest rates high. If you like the video, please subscribe to the channel and activate the notification bell. Like the video, stay well.